Hello and welcome to Market Domination Overtime. Stocks closing mostly lower on AI spending fears. Let's send it over to our very own Jared Lickery, who is here with the latest moves. Jared.
Thank you, Josh. Well, we got a mixed market because the Dow photo finish managed to close in the green, just barely there. And let's check out the intraday price action. And you can see we spent most of the day in the red, although we started in the green and we ended in the green. So I guess the close is what matters here. NASDAQ, however, not as strong in the end, although it was a nice rally off the lows. At one point at those lows, it was the worst day in the NASDAQ composite in several months. S&P 500 just finishing with a very small loss, about 13 basis points there. And I will show you that the S&P 500 equal weighted index, and that's where every stock gets one vote, that finished in the green like the Dow. It often tracks the Dow's performance. Russell 2000, small caps underwater by just a small amount there. So all in all, the day could have been much worse had we closed a few hours ago, but we did not. And guess what? Microsoft was the culprit here. That stock was down about 10%, 12 or 13% at the lows. I'll just pull that up briefly, and you can see, wow, what a red day there. We haven't seen Microsoft down 10% in several months. Tesla also down 3%, but another earnings story here, Meta, that was up 10%, and that fueled communication services, which is XLC. I'm going to show you the sector action now, to the best, to a record high and the best performance in several months. So there's kind of a trend here. There was kind of a day of have and have not. So communication services, XLC in the top spot. Real estate, financials, industrials also closed at not records, but above 1%. Tech was the worst off, down 1.6%. That was fueled mostly by software. So let's take a look at that industry. You're going to see a lot of dark red here, although IBM in the upper right, that was up 5%. There's an earnings story that was positive for Big Blue. If I sort by performance, you can see SAP led the way down. Another earnings story that was a disappointment for investors. That was down 15%. Hub's down 11. Atlassian also down 10. ServiceNow, MongoDB, Twilio, all of those down about 9-10%. So just kind of across the board. And that has been a very poorly performing sector this entire year for the most part. In chips, we do have some red, but not nearly like we saw in software. And for that matter, Lam Research up 3.5%. That was an earnings story. KLA up 3.5%. Sandisk up 2%. List goes on there. I'll show you what happened with the Dow to finish things up here. And here we have Caterpillar. That was an earnings story that ended in the green. That was up 3% today. And I'll just show you the one-year chart on Caterpillar, up 69%. Off of those April lows, it's been from the lower left to the upper right. That's what you want to see there. Very low volatility. Honeywell also up about 5%. That's in the industrial realm. Although Boeing down 3%, and Salesforce, that's your software story in the Dow, that was down 6%. And let me just take a quick look at our leaders here, because I did want to show you Bitcoin was a risk-off leader today to the downside. That was down about 5%. Even worse than software. IGV is a software ETF that you can see there. TAN is solar, IPOs, ARC is disruption, quantum, retail, all of those were down 1% or more. To the upside, we got oil in the upper left, transportation, real estate, and also regional banks. Also mentioning biotech. Biotech did decent today. So kind of an interesting mix, a dichotomy there. And as I said, could have been a lot worse, Josh.
All right. Thank you, Jared. Well, crude oil prices rising to their highest level since September as Donald Trump weighs up a major strike on Iran. The president's latest threats come as nuclear talks stall between the U.S. and Iran. Jake Conley is with me now to walk through this. Jake, let's just start here, Jake. Trump's threats here. What are the odds that strikes actually happen? I mean, when you check in with analysts, what are you hearing?
I think it's hard to say with any certainty what the administration is going to do. But what analysts have been telling me is the thing to watch for is not rhetoric. The market's not going to trade rhetoric. It's going to trade actual operational signals, right? Are there naval ships being positioned nearby, like we saw last night with Trump's acknowledgement of the, quote, armada buildup? Are there evacuation orders being sent out? Are there real signals on the ground that something could be coming? Mm-hmm. The market's not pricing in war right now. It's pricing in a risk premium. That's why you saw oil up 4% today, but it's not pricing in a real huge conflict. That said, another analyst said to me today that Trump has been, by and large, much better about following through on his military threats than on his tariff threats, right? So hard to say, and there are still diplomatic off-roads. but I think we'll have to see what the administration does.
If strikes do happen, what are possible implications for oil markets we need to think about?
Well, I think you'll see an immediate risk premium apply. Oil prices will jump right away, even if barrels are not taken off the market just on the risk alone. But the key thing to watch with Iran is the Strait of Hormuz. 20 million barrels per day of crude and other petroleum products go through there. That's about 20% of all global maritime trade of crude. It's a huge global choke point. Iran largely controls it. They wouldn't even need to shut it off for you to see real price jumps. Just the threat of that action could send prices soaring. However, some analysts tell me this is something that Iran has talked about doing for a long time. It's something they've never really done. The question is, could they even actually pull that off? But it's still going to be the risk premium that people are watching just because Iran has that major lever to pull over that choke point.
Finally, just switching gears here, earnings on deck, Exxon, Chevron, what are you listening for? What are you expecting here?
Well, it's similar. It's all going to be about geopolitics tomorrow for me, right? You're going to see questions about Venezuela and how these companies are thinking about political risk there and whether there's opportunity, especially considering how hard the White House is pushing it. For Chevron, you're going to see questions about their assets in Kazakhstan, where there's been a huge loss of output based on some outages in fields, some damage to export terminals. The second side of this is just the raw plumbing of these companies. How are buybacks looking? How are dividends looking? And then the questions I think analysts are going to be asking are, what is the upstream end looking like? New barrels are just getting harder and harder to produce and find. We've seen this over the last few quarters. So can these companies keep up that cash flow, keep up those buybacks, those dividends, even as the upstream assets may take a bit of a hit?
All right, wait and see. Jake, thank you.
Thanks, Josh.
We're watching Amazon here as the company reportedly nears a deal to invest in OpenAI. The Wall Street Journal now says the e-commerce giant is in talks to invest up to $50 billion in that startup. At that level, it would make Amazon the largest contributor to OpenAI's ongoing fundraising round. It's reportedly looking to raise $100 billion in this round. SoftBank is also in talks to invest, as well as the companies already have a strategic partnership in place. Amazon also has an investment in OpenAI's rival, remember, Anthropic. But all this spending is coming at a cost. Just this week, Amazon announced it's cutting 16,000 jobs. Coming up, we look at how the Fed's policy decisions are impacting the housing market. That's next on Market Domination Overtime. Sandisk second quarter earnings just now crossing the wire. Here to break it all down is Yahoo Finance senior markets reporter Inez Ferrer. Inez.
Yeah, Josh, a beat on the top and the bottom line, and by a wide margin, by the way. Sandisk, their revenue for their latest quarter coming in at $3.03 billion. The street was expecting $2.68 billion. Earnings per share coming in at $6.20. Adjusted earnings per share estimates were for $3.44. Their guidance for the next quarter is also higher, so they're now expecting $4.4 to $4.8 billion in revenue. The street was expecting guidance of $2.86 billion, and adjusted earnings per share also. Street was expecting something around $4.60 per share. They're coming in with $12 to $14 per share. This is the maker of memory products and storage products. This is a crucial trade when it comes to the AI trade. This is a crucial component, I should say, of the AI trade. And this stock has been on fire year to date, up more than 90%. Last year also up as well, triple-digit percentages. This has been one of the best performers of the S&P 500. And memory and storage is something that even Jensen Huang has talked about, that this is an unmet demand for data storage in the AI era. So this is certainly one of those stocks that's been on fire, and in after hours also Street is liking these results. Josh?
They sure are. Inez, thank you. All right, let's get some more analyst reaction here to Sandisk's second quarter earnings. Joining now, we got William Kerwin, Research Services Equity Analyst at Morningstar. It is good to see you, William. So listen, Sandisk numbers are out. The stock is ripping higher here, William, in the after hours. That's, of course, heading into the print. This thing was already a rocket ship. What do you make of it, William? Is it about what you expected? Are you surprised? Walk me through it.
Well, listen, Josh, this is a phenomenal print, and the guidance looks even better. Earnings looks like it doubled consensus for the results printed today, and it looks like it's more than double what consensus estimates were coming in for the next quarter. But memory stocks are making this look pretty routine at this point. We were just hearing about how well Sandisk has performed. I believe it's up more than 12 times over the past 12 or 13 months since the start of 2025. And what we're seeing is that this is a commodity product, but it's an incredibly scarce supply. And so demand is going way up for AI infrastructure, especially given some of the announcements that NVIDIA has been made about using these NAND storage chips to enable better performance in AI models. And the supply moves at a much slower pace than demand does. And so what you have then is this huge demand, and that creates prices that skyrocket, to use a term you used earlier. So we're seeing that here with Sandisk, and it's hard to say that we expected just how good these results were, but again, this really fits the pattern of memory stocks over the past year or so.
To your point, this stock, just to remind viewers, just take this year. Heading into this print, this stock was already up 130% heading into this report. You can see how much we're higher there. Just parabolic move. To put it simply, William, is the explanation for that move, and correct me if I have this wrong, but listen, AI servers, they need Jensen Huang's chips. They need NVIDIA's chips. They also need fast, reliable memory, and a lot of it. Is that the explanation?
It is, and I think it's important to denote the two different types of memory here. So if you think about a company like Micron, they specialize in DRAM chips, and those are the chips that go on board in these AI servers right next to or on the GPU. What Sandisk does is a little different in its NAND memory that's traditionally used more for storage. So if you think about a solid state drive, those are based on NAND chips. But what we're seeing is that as we move into a bit more of an era of inference spending in AI, when you use models for inference, they're typically stored on an SSD that's powered by NAND flash. And now it seems like there's more of a push to use these NAND flash chips in the actual processing of these AI models. And so, I think at a high level, you're correct. As AI infrastructure demand goes up, so does the demand for these chips. And again, that's against scarce supply that cannot move as fast as demand is. And that creates the pretty insane prices that we're seeing right now.
And what's impressive, William, my friend, is that even after this move, you still have most of your colleagues on the street, around 60%, they still tell their clients, you should be buying this one. But you, I think, William, make sure I have this right, you have 1 star. Am I right to say that's the Morningstar equivalent of a sell? For one, correct me if I have that wrong. If I'm right, though, William, I guess what assumptions do you think the bulls are making, William, your colleagues, that are misplaced?
So you're correct that it's the equivalent of a sell rating, and by a pretty significant margin, especially after this move after hours. Really, this comes down to time horizon. We focus on a long-term time horizon, and I talked about how these chips are commodities. It's pretty fungible, whether you're getting a chip like this from Sandisk, from Micron, from Samsung, from any number of other players. And while we're seeing this tremendous upcycle in the short term, and we think that it can last for a few years more here because of those supply constraints, we do not expect this period of pricing raises and pricing raises of this magnitude to go on forever. When you look at the long-term trajectory of the memory market, you see cycles over time. This is probably the biggest cycle we've ever seen in terms of the upswing. But typically what you see is a pretty precipitous downswing once that cycle peaks. And so what we're worried about and what's keeping us more conservative here is that because of these supply constraints, we think Sandisk and its peers are going to start building out supply. And we may get to a point, maybe it's not until 2028, maybe it's not until 2029 or 2030, but where the supply gets built out, and it's not really a question of whether demand goes away, but it's a question of the ratio of the supply to this demand. And once you get even just a little bit of supply that exceeds demand, these prices can crater just as fast as we're seeing them go up right now. And that gives us some caution when we think about buying into the stock at these meteoric levels.
That's what I was going to ask you, William. Like if I'm an investor and I'm listening right now, what I was going to ask you, what are the signs, what are the signals I would be looking for that peak in the cycle is coming? Whether you would say, okay, keep your eye on on pricing or capex or inventory?
Well, we think it's really the timing of these build outs. And when you think of building out more supply for these chips, it includes building out an entirely new facility, or fab, as we call it in the industry. And we're looking at 2028 as a line in the sand here, where we think a lot of this new supply will come online. We think that these prices can stay pretty high until then, because we don't see a ton of new supply coming online. We think prices can continue to go up. But once you get a surge of that supply coming online, both from Sandisk and from these peers, that's that point in the sand that I said that we're looking at, where we worry that that could create maybe not a huge glut of oversupply, but it can bring prices back down to earth and create a bit of a negative catalyst there.
William, always good to see you. Always appreciate that instant analysis, sir. Thank you.
Thank you, Josh.
U.S. mortgage rates holding steady at their lowest levels in 3 years. That's coming from new weekly data from Freddie Mac, with the 30-year fixed rate averaging at 6.1%. Housing investors keeping a close eye on policy shifts from the Fed and the Trump administration. Joining now to unpack all this, we got Morgan Stanley U.S. housing strategist Jim Egan. Jim, it is great to see you. Let's start on that mortgage rate. So we're sitting here, 30-year fixed at 6.1. You talk about, though, Jim, how when it comes to housing affordability, it's more than just rates, right? What do you mean by that?
So when we think about affordability from a perhaps overly simplified perspective, it's a three-pronged equation. It's mortgage rates, it's home prices, and it's incomes. So the decrease in mortgage rates you mentioned, we're hanging at about 3-year lows right here. That's helpful. Affordability has improved. Home prices are still at all-time highs right now. And so if we look back over a longer window, 30 years, 40 years, this is still one of the most challenged affordability environments that we've really been in from an ownership housing market perspective.
You also walk me through this. I mean, you talk about secondary effects have been coming through supply. What do you mean by that?
So one of the things that has had the housing market a little bit more stuck over the past 3 years, we talk about the lock-in effect a lot, right? And what that means is a majority of what we have in the mortgage market in the United States, 30-year fixed rate mortgage. Weighted average rate there, below 4.25. Prevailing rate, you just mentioned, 6.1, almost 200 basis point difference. What you're incentivized to do as a homeowner at that point in time is effectively take your home off the market. You can service that very low interest rate mortgage. Your affordability, by the way, has probably been improving. Your payments stayed the same. Your income, household incomes at least, they've been moving higher. So your affordability is improving, while the first-time buyer, the people stepping into the housing market, theirs has been what's deteriorating. And so as rates have come down, when we say second-order effects, what we're seeing is listing volumes are finally starting to increase. We had hit historic lows in 2023 from the number of homes actually listed for sale. We've picked up. We're up off of those all-time lows. We're still 20% below where we were in 2019 before we went into the pandemic and this interesting environment. So it's still a tight environment, but we're starting to see some of those secondary effects of lower rates in more inventory coming online.
On this issue of supply, Jim, I recently spoke to this to a very smart housing economist. I asked her about supply, her thoughts there. Take a listen to what she had to say.
It's easier from a policy perspective to get demand side policies across the line, but the supply side is where we really can make a difference from a policy perspective. But that's hard to do because a lot of those supply side fixes need to be done at the state and even local level, things like permitting rules, zoning, land availability. So it is a challenging road to approach, but I think that's where we would have the most effective results in the long run.
And Jim, what's interesting, the point she's making there was actually echoed by Jim Bianco on X. I saw this, smart guy, right? He says the fix is more supply. He says get rid of restrictions, zoning laws, he says, building regulations, land use rules that hold back construction. What do you make of that?
So I think the most important thing she said there as I was listening to those comments, state and local regulations, right? It's much more difficult to do that from a federal level. When we think about supply on the new home side, I was talking about existing listings where the lock-in effect really has that implication. But when we think about building volumes, we do subscribe to the idea that we probably haven't been building enough over the course of the past 15 years. We have a number of different ways to solve for that shortage in housing. Some of us get us to about 1.5 million units shy of where we need to be, and that's inclusive of single unit, multi-unit ownership, rentership. We have other algorithms that get us to a little bit larger of a shortage. So over the medium to longer term, we agree with the idea that we need more supply. Shorter term, the existing housing market, the new housing market, they're on slightly different paths right now. I talked about how shy we were from a listings perspective on existing inventory versus 2019. New homes listed for sale right now, highest level since 2007. We've seen that weigh on new home prices relative to existing home prices. That basis has really closed, really to a tighter level than we've seen in decades. So in the shorter term, we do think that you need to clear some of that inventory. Helping from a demand perspective, we do think would help there.
President Trump has also been very focused on this issue, right? Housing, affordability. Some of his ideas, Jim, mortgage bond buying, ban big institutional investors from buying single-family homes. What do you make of those policy ideas? Is that a smart policy in your opinion?
So I think the mortgage buying. My colleague Jay Backow in research at Morgan Stanley, we were overweight mortgages coming into the year under the idea that there was going to be more demand for mortgages this year than we'd seen in the past few years. The big buyers we thought were U.S. banks and the GSEs, Fannie and Freddie. Now, we weren't calling for $200 billion of additional buying from Fannie and Freddie, but we do think that's something that helps. Our forecasts, we have mortgage rates coming down an additional 15 basis points with that potential $200 billion in purchases. That helps on the margins. We were already expecting existing home sales to increase this year by about 3 to 4% versus where they were in 2025. It doesn't pick up our expectations that much. The reason for that, over 50% of mortgages below 4% right now. Because of how quickly mortgage rates moved from 3% to 7%, you have this concentration above 6% now. Mortgage rates have been elevated for 3 years. You have that concentration below 4%. From 4 to 6%, there aren't that many mortgages outstanding. So as we start to move incrementally below that 6% handle, maybe you get a little bit of a media effect from having that 5 handle on mortgage rates for the first time since 2022, but you're not unlocking a lot of kind of excess inventory. We think it helps on the margins, and that's something that we already thought was going to happen this year, happening in bigger size and moving the needle in the right direction, even if it's only modestly.
Jim, great to have you, especially on set today. Thank you, sir.
Josh, thank you for having me.
Time now for what to watch Friday, January 30th. Starting off on the Federal Reserve, we're going to be getting our first round of Fed commentary since the Fed's decision to hold interest rates steady on Wednesday. This is coming after 3 straight cuts last fall. 2 officials voting against Wednesday's decision, pushing for another cut, citing concerns in the job market. We're also capping off a huge week of earnings ahead of the open. 3 Dow components reporting. That would be Chevron, American Express, and Verizon. SoFi and Regeneron also key stocks to watch. And in the energy space on top of Chevron, ExxonMobil also reporting ahead of the open. Analysts expecting lower oil prices could cut up to $1.2 billion from the company's Q4 results. But refining margins are improving, mainly because input costs are lower, and that could add up to $700 million to offset the losses. Turning to the economy, some delayed inflation data coming out on Friday with the December Producer Price Index, or PPI. Economists forecasting total PPI to hold steady at 0.2%, while core PPI ticks up to 0.3% on a month-over-month basis. That's going to do it for today's Market Domination Overtime. We've got Apple earnings on deck. Stay tuned. You don't want to miss it.